guys. We're just getting the last people in from the waiting room. But why don't we start? I wanted to welcome everybody to NAIOP Edmonton's first breakfast on rising insurance costs. My name is Anand Pai. I'm the Executive Director at NAIOP Edmonton, and I'll introduce our moderator, Rudy Rupnerine, in a moment. But first, I wanted to talk for a minute about the idea behind this breakfast. Obviously, this is an issue that's affecting our industry, and NAIOP wants to be able to drill down into the specifics of things that come up through the occasional breakfast. So if you have an idea, send an email to me, anand@naiopedmonton.com. In addition to our monthly luncheons, which now happen on the second Thursday of the month, but we'll be taking a break over the summer so that we can focus on things like golf and hopefully our cycling event. All of this is made possible by our sponsors. We want to thank our existing sponsors who've made NAIOP the voice of commercial real estate. You saw their logos playing during the introductions, but I want to take a second to thank our Prestige Club sponsors, Panettone Developments, Qualico Developments, Remington Development Corporation, and Quadreal, as well as our President's Club sponsors, Pangham Development, Camrock Capital, Bentall Green Oak, Melcor, One Properties, and Ledcor. You can see so many companies have signed on, and if yours isn't on the list, please consider the industry advertising, membership, and events that NAIOP sponsorship provides. You can send me an email about that too at anand@naiopedmonton.com. But now to the main part of our event, I wanted to introduce Rudy Rupnerine. Rudy is the Commercial Development Manager now at Rohit Group of Companies. With over 25 years of experience in the development industry, Rudy's held senior roles in organizations from the retailers, lens on design, construction, leasing, and property management to development and construction. He's worked throughout Canada and the US on projects with exposure to varying requirements of the industry. Rudy's been involved with the development industry associations like ours at NAIOP, where he's the chair of our advocacy committee, and through the board of UDI since 2012, and strongly believes in the advocacy efforts to ensure that the impacts of policy on the development industry are carefully thought out and don't limit the industry's ability to continue development. So welcome to Rudy.
Good morning, and thank you very much. Welcome, everyone. Thank you for taking the time today to talk about insurance. Sometimes not the most exciting topic, but maybe there's a few of the panel members might disagree with me on that. So thank you again for attending. Our discussion today is meant to be more of an informal discussion, highlighting on the key points of the insurance industry related to both construction as well as operations of the buildings. As you know, many of us are both contractors as well as operations. We take care of the operations of the buildings as well. So I would like to start by introducing our panel today. Basically, each of them will tell you a little bit about their companies themselves. So I will first start off with CoreAlta Construction. We have Ken Corbett, who is the Vice President. Ken?
Thank you, Rudy. Pleasure to be here. With CoreAlta Construction, been here for 17 years, partner for about 15 now. CoreAlta is celebrating our 30th anniversary this year. Proud to be announcing that. And we're a Western Canada-based firm. We've got projects across all 4 Western provinces currently under contract. We have satellite offices in Red Deer, Vermilion, and Kamloops, as well as our head office here in Edmonton. We're a general contractor that we pretty much do anything our clients ask us of us. We build quite a bit of the CRUs and strip malls. We've worked up north in the oil sands for the CNRL, Cenovus guys. We do a lot of restaurants, fitness, grocery stores, pet stores, multifamily, medical clinics, schools, and gas bars. So quite a broad stroke across the market, and quite a bit of experience across Western Canada, as well as working in remote locations up north on the Indigenous reserves and such.
Very good. Thank you, Ken, and welcome. From Hub International Insurance Brokers, we have Daniel McAllister, who's the commercial account representative, Matt Shank, who's the senior commercial account representative, and we have Doug Lyle, who's the Chief Sales Officer. So I'll let you guys introduce yourselves and what you do.
Well, thanks, Rudy. I'll jump in first quickly here. So I've been with Hub for going on 9 years now. I've been a member of our construction services team in Edmonton here for almost the entire time. So we've got a team of about 20 people who focus solely on construction and surety bonding and everything that comes along with it. So we spend a lot of time talking to contractors, talking about project insurance, contract advocacy, those kinds of things. So.
Super. Doug or Matt, do you want to add some onto there?
Sure. Good morning, everybody. Matt Cruikshank here. I have been with Hub International for 18 years. I specialize in commercial real estate insurance as well as residential multifamily insurance, such as condominiums. And I currently assist in leading our Hub's real estate specialty practice. So thank you for having me.
And Rudy, thanks very much for having us. I'm Doug Lyle, Chief Sales Officer. So I look after all of the insurance for Alberta and Northwest Territories of Yukon for Hub, as well as I'm the Canadian construction practice lead for our specialty practice and construction. So Hub International actually started in 1998 with a decent sized office in Chilliwack and in BC and Ontario. We're both an amalgamation firm as well as a growth firm. So we specialize in a lot of mergers and acquisitions across North America. Since 1998, we've now grown to the top 5 brokers in the world. We are all across the US and Canada, with one that I keep trying to transfer to in Puerto Rico, but nobody wants to move me there. We really specialize in commercial insurance of all sorts. I think the biggest thing that we advertise is we're borderless. So we bring in the best products and services we can from the US to Canada to serve our clients in both risk management as well as insurance. And I think we really put the client first and then come up with a solution that fits their needs. And what we're going to talk to today is a lot about where the insurance industry fits in the development world and what's changing and how hopefully the insurance industry can help you guys make more money at the end of the day. So thank you very much for having us.
Great. Thank you very much, gentlemen, and welcome to today's meeting. And a quick thank you for taking the time to educate us on the insurance industry, because there's a lot of folks who will be on this call who's not, it's not in their workspace every day. So I think this will be a great one for them to learn. Just a little housekeeping that we're going to take care of. If you have any questions during the presentation, we're going to answer the questions at the end, and that's going to be probably moderated by Anand, and we're hoping to leave about 10 to 12 minutes after the discussions, and that will give you ample time to ask anything that you may want from the panelists themselves. All right, so why don't we just get down to the start of the questions, I suppose, that I have for you. I'm not sure which one of you from Hub will handle this, but please provide an update on the overall current state of the insurance industry.
Thanks, Rudy. The gentleman volunteered me for this one. So I think what I would consider, I've been around a long time, I'd consider it in transition. Insurance industry over the past 5 to 7 years has really moved to a data-driven industry that instead of looking just backwards and saying what happened in the past 5 years, we should underwrite and rate for that going forward. They're starting to use a lot of predictive analytics to focus on what's coming in the future. So they're using data from past losses to try to learn what's going to happen tomorrow. So that is along with predicting what forest fires, hailstorms, what kind of analytics they can use to drive probable cause of loss in the future. So I think where the industry is at is it's now collected that data for 25, 30 years, and they're now starting to put that data to use to try to predictively analyze where we go and how they put their money to risk. I mean, an insurance company is generically built around the premiums of many for the losses of a few. And where the industry is taking this data now is trying to predict where that is best placed and where they can put the most money at risk. And what you're seeing right now as the industry goes through that is you're seeing some restriction in capacity. You're also seeing new capacity come to the market where other countries and investment firms around the world are looking at Canada as somewhere to put capacity because they feel that we've got some of this figured out. So you're seeing an industry, in my mind, in transition, but also in an ability now to stabilize and in future, I believe, better handle the highs and lows of the market and prepare themselves for the catastrophic losses that do come, but have actually rated and structured their company to handle those instead of reacting like we've seen in the past where there's a catastrophic loss and then rates skyrocket the next year.
Well, it sounds like they're doing a lot of analytics, as you've mentioned, Doug. And obviously, we always worry about why insurance rates continue to go up. And one of the things I'm understanding is that there are less main insurers today than they were, let's say, 20 years ago, 10 years ago, and even now. Can you elaborate on that?
Yeah, I think what you're seeing is, again, it's a mergers and acquisitions world that we're all in. I think you're seeing that in a lot of industries, and insurance is no different. You've seen over the past, ING became Intact, which purchased, Guardian when it was ING, it's purchased Jevco. So you're seeing somewhat of a contraction in the domestic marketplace. But what we're seeing is a replacement of foreign capital that does that. So you've also seen more Lloyd's of London brokers open up, Berkshire Hathaway. You're seeing Berkeley come to Canada with more money. You are seeing a transition where, as much as there's a fewer level of domestic insurers today, you're also seeing some growth and capacity coming from outside of Canada. So I think what you're going to see is continued contraction. The biggest exposure, though, is the capacity. So where we get most concerned from a broker standpoint, and I see some of my compadres from the industry in Edmonton on the call as well, is it really comes down to how much capacity we have to put to work. So an insurance carrier is a big deal, but it's also how many of them are willing to put capacity to work. And where we're seeing the twofold approach right now is a restriction in number of companies, but you're seeing companies not willing to risk as much capital on any one investment. So where that comes in, if you had $100 million building, and 5 years ago, an insurance company would have taken 25 or 30% of that risk, today they might only take 10%. And if they only take 10% of the risk, now I need more capacity to fill the insurance capacity for that building. And I think that's where we're seeing more pressure on rate, Rudy, than just because of the number of carriers. What we're seeing is a restriction in capital into the marketplace, or the ability for companies to risk their capital on any one site.
Doug, I've been hearing for a long time, and you can reflect on your own insurance that you pay, and you hear insurance costs are going up again. And it's going up. I don't know if anybody who's told me their insurance has gone down. So why does this continue to happen?
It's a derivative of two things. And right now we're in what I would say the perfect storm, in the fact that we've got a deflated bond market. So the insurance carriers can only invest in very restrictive investments. They're usually looking for somewhere between a 8 and 10% return on investment on the capital throughout the year. And with the bond market down, with the investment capital that they have also restricted, they're just not able to get the returns outside. So they've had to turn to complete underwriting profits. So in the old days, Rudy, if an insurance carrier could have ran at break even, let's say, on losses, but they could have made 10 or 12 points in the market on the bond market, they didn't need to make an underwriting profit. Well, now they've turned to where they have to make an underwriting profit. And with all the analytics, they're choosing where they risk that. And again, with the capacity going down, that has driven rates up. The good news, if there is something in this right now, is I believe with the analytics, we're starting to see a flattening marketplace. We have recently renewed accounts for less than last year, and we've actually recently got some capacity in the marketplace that's helped us start to reduce. I know Matt's just renewing some files that are slightly less than last year's pricing on some realty, and we're starting to see that on some lines. As the transition goes, Rudy, the problem is we just also had a $65 million frame COC claim in BC, another $15 million frame COC claim in BC. So we're also seeing some losses, but we aren't seeing a reaction from the insurers at this point that's actually going to continue to drive rate up that much more. But they do have to make profit on underwriting. So if they're losing money, which they were in Alberta, especially for a long time, the rates continue to drop. I mean, at one point, the average loss ratio in Alberta for a carrier was north of 100%.
That's quite scary, actually. The COC, just clarification on what COC is. I believe I know what it is, but for everyone else?
Completion of construction. So it's basically the policy that would be placed on a building while it's under construction.
Rudy, just really quick, that's sometimes referred to as builder's risk. The members might also hear that term thrown around as well.
Excellent, thank you. So, as insurance costs have increased over the past few years, where would you say the sector, the biggest sector that's been most affected by rising insurance costs in the, let's say, the past 3 years?
Yeah, the past 3 years, the number one has been residential realty. Residential realty, and this is, I don't have the better gene to say this. So they somewhat deserved it, and not meaning that negatively, but the buildings were having losses. We had a couple of buildings, $2 and $3 million of the water losses on $50,000 of the premium. So you just can't sustain that. So the residential realty marketplace had to change. I think it's stabilizing now at a rate where the companies can absorb the risk. The clients have been pushed to have higher deductibles. So that would be the number one affected. I think number two would actually be transportation, and transportation was affected by the perfect storm of less carriers wanting to write it, and losses going up, and again, return on investment being down. So transportation took we were seeing 300% and 400% rate increases. If you go down east, and doesn't affect Edmonton, but in Quebec, there was a restriction of marketplace, and the minimum rate increase for 12 months was almost 100%. And then the third would be the building industry. You're seeing that with completion construction, with, to Danny's point, with it's builder's risk. Because of restriction and capacity, you've seen a rate shift where instead of being 1 and 2 cents, they went up to 4 and 5 cents. And, which frame COCs capped out sometime in October around 7 cents, depending where it was at. And some of the north stuff was far north of that. But we've seen a definite restriction of capacity in construction. And then we've seen the increased cost of claims go with it, especially in builder's risk.
Okay, maybe I can just hone in on your comment about residential for a moment. The city of Edmonton, actually, one of their main drivers for growth over the next 50 years will be looking at building more core development. And with the core development, we're probably looking at more high-rise buildings or mid-rise buildings. And, with insurance rates basically being affected greatly, that it's actually impeding perhaps the starts and projects. Now I've been being told that. How do you see us coming out of this for residential and actually for future growth of the city, if that's what the city wants to do?
I think there's a 2 or 3 pronged approach to this, Rudy. We've spent a lot of time working with some of our risk management team, and I think it's to start with, it's better risk and better management on the project site. If you look at some of the developers, some of which I see on here, they haven't had losses. They do phenomenal work up front. They specialize in making sure their sites are tight, they're clean, they have the proper security and safety measures, and they just manage their buildings at a high level. And at the beginning phase for construction costs, that's what the insurers are going to look at. They're going to look at the best in class operations and say, okay, that's how we have to rate. For the future management and sustainability, it's about building sustainable buildings. Last week, and I was hoping to have it to share with this group, I don't have it, but last week there was a burn demo of a frame building in Edmonton. They burned a 3-story frame building, and they burnt a 3-story building that was sprayed with a fire guard. And the 3-story frame building was a loss that wasn't sprayed, and there was minor damage to the other building. You're looking at, I know PCL is doing a lot of work, and there's a lot of developers doing work now with automatic water shutoffs for sustainability in the buildings. We're looking at heat temperatures. We're looking at ways of making the long-term livability of a building and the lifespan of a building better. And I think that lifespan investment is going to be where you're going to see the best investment and return, Rudy, from the developer standpoint, and especially the building owner standpoint long term, because that's where the insurance carriers are going to risk their money. They're going to look at it and, is this a long-term sustainable building that has proper risk management, mitigation efforts up front, because that's going to reduce the probability of loss down the road.
Okay, interesting. So obviously we have to do a little bit more homework to understand those components.
Yep.
So I guess I'm going to pivot a little bit and talk about actually new builds and renovation projects. And what are the key factors that determine insurance rates for renovations as well as new builds?
Yeah, thanks, Rudy. I can jump in on that one and give Doug a bit of a break. So the 2 main factors for premiums and insurance costs on those types of projects are the construction details of the project and the overall location. So when we talk about construction details, we're talking about the materials, whether it's wood frame, non-combustible, fire resistive, and then construction of things like the roof, walls, exterior, fun stuff like that. Location, obviously, urban versus rural location, you're going to see a big swing on course of construction or builder's risk insurance rates for the most part. And that has to do with things like proximity to fire hydrants and as well as fire departments. When you get into rural work, there's like very unlikely that you'll have fire hydrants present, and you might have a volunteer fire department staffed by five people. Whereas if you're in the city of Edmonton and you're just down the street from a full service fire department, that all factors in. So insurers do use a rating system where they grade each location by postal code. So they have a grade that they assign as far as fire protection that does filter into your course construction rates when you're building a new building. Other factors would be flood zone information. If you're building right on the Bow River, as we've seen in the past 10, 15 years, that can be precarious and lead to claims versus if you're at the top of the river valley in Edmonton, very unlikely that you're going to have an overland flooding claim. And then Doug touched on it a little bit earlier, but just density of properties and the nature of the adjacent properties. So insurers, especially nowadays, are not big fans of clustering their own risks together. So you could have two new, say, 5-story frame project buildings going up side by side. The same insurer is unlikely to want to insure both of them at the same time, because that's double the risk for them, and it's much more likely that they would have a claim on both buildings. So the density of buildings as well as the nature of adjacent properties can filter into that as well.
Okay, thanks, Daniel. Ken, I know your company does quite a bit of work outside of the primary zones and out into the country. So what are you seeing, and what do you have to do to make sure that you keep your insurance costs down, number one? And number two, is there any situation where the insurance cost will be greatly impacted by other factors, say a fire watch or something like that? Can you talk about that for a moment?
Perfect. Thanks, Rudy. Doug and Danny have already alluded to this a little bit with the builder's risk cost. But really, when we do projects for us, there's two different types of project that will affect our builder's risk. The one project is non-combustible. So if we're running a non-combustible project, it pretty much doesn't matter where we are, even if it is pretty rural. But a non-combustible project would probably run us less than 0.5%, maybe even 0.25%, depending on our location for our overall safe project costs. Where if we do hit combustible construction and we are a little bit more rural, like Doug had alluded there at the 7 cents, well, we've seen builders risk or combined insurance costs be up to about 1% on the project. So that's quite a significant increase. And that's just the insurance, where quite often when we are working in the rural areas, where we don't have the fire departments that Danny has alluded to, and that the insurance companies will come back to us and look for warranties to be added to it. And basically what a warranty is they'll need either a full-time watchman. Quite often now, security cameras aren't good enough, but they need boots on the ground, a guy watching it when we don't have anybody on site. And so say if we're working a 50-hour week, that leaves quite a few hours on top of that, right? And so if you could be spending $3,000 a week just to have a watchman on site to satisfy your insurance underwriter. And so that's even more than the insurance cost in some cases, in order to mitigate the risk to be able to even get insurance. So that's a big cost that can be added to the project. And so then when we are looking at those projects out of town and even in town, like the gentleman from Hub alluded to, how you set up your site does have quite an impact on our rates. And our past performance definitely has helped us with our rates and with our ability through our brokers at Hub to be able to get preferred rates, we think, in the industry, and ensuring that we're good performance moving forward, that we're providing information that we can find to our brokers to let them know that, okay, yeah, we've got, this is how the site's going to be laid out. We do some research, find out more about the fire department for them to maybe help us to offset and mitigate. We'll go out and, as you see in the commercials, counting off to the hydrant how close you are, right? Make sure that the hydrants are active. Sometimes we'll go in ahead of time and install the hydrant before the site starts, so that we do have fire service to the building, and many different ways we can mitigate. And the big thing is we talk to our brokers and the underwriters as to the best way to be able to mitigate those costs on the project.
Okay, well, thanks for that, Ken. I'm just going to do a little bit of a follow-up question with you, Ken, on that. I know you just mentioned percentages of what the overall construction cost would be for insurance. So can you tell us a little bit more about that? Because, you know, oftentimes as an owner, we're hiring our general contractor and we see an insurance number on there. And oftentimes, depending on the project itself, that fluctuates quite a bit. So you said anywhere from 0.5% to 1%, is that correct?
Yeah, so quite often, say if we're doing a non-combustible project in Edmonton, we'll probably get an insurance rate at about say 0.3% kind of thing that would be relayed back to our client. Where if we are, say if I'm doing a wood frame up north, we've done up on one of the Indigenous reserves. We've had our insurance rates have been just over a percent of the construction cost. And so that's quite significant when you're looking at, say, a $10 million project. Between you're shifting 0.5% on $10 million on construction cost alone, let alone any other warranties that are involved from the underwriter to be able to garner that insurance policy.
Wow, that could certainly add to some costs for owners. And thanks for that, Ken, for clarifying that anyways. You know, I'm going to just ask a little bit about, we've constructed the building now. We've handed it over to our operations team. And our operations team obviously has to get insurance on the building. And I know a little while back you alluded to the fact that, you know, there's a number of factors that determine the insurance rates during construction. Are those factors the same once we turn to operations, or are there any outliers? Are there any additions, any subtractions? Would you be able to help us on that?
Sure, thanks, Rudy. There are a few the same. Danny touched on a few of them, but I'll start with some of the ones that he hasn't touched on. So once you're done the build and you're ready for tenants to move in, you're looking at, are these high risk or low risk occupancies? Some low risk occupancy would be light retail office space, or are you going to have liquor stores, cannabis operations, trampoline parks in there? So the occupancy of the building is going to determine the rating of that building from insurers. Danny did touch on the mapping, both flood mapping and capacity mapping. Those, again, are going to be factors that insurers take into consideration when putting rates on that building. Construction details, frame versus steel on steel versus concrete fire resistive. And some of the other things they're going to take into account, as Doug had touched on earlier, the mitigation work that was put into that building. Are there water shutoffs in each unit? Are there water sensors? If it's a frame build, has it been sprayed with barrier tech? If we can go to the insurers and say, here's what the client's done to make sure that they have mitigated their risk as much as possible, you're going to get more favorable terms from insurers. They, like Doug said, they have to decide where they're going to risk their capital, and they're always going to choose the best in class risk.
Okay, so definitely certainly things to look at from a design point of view for a lot of our builders, owners, in order to mitigate some of those costs.
Yeah, and a lot of the time, I mean, a building can start out with low risk light retail office occupancy, and they may have a bay come up for lease or rent, and think, oh, well, great, I have a tenant here, and it just happens to be a trampoline park. Well, that nice rate that they had on that building with the office and retail space is just being blown out of the water because of this one tenant. So you kind of have to manage what kind of risk you want in that building.
Now, is it because the trampoline park is on the roof of the building? Is that what the danger is?
Well, I think some insurers may think that it is on the roof with the rates they put on that, but just the severity of the claims, the liability issues that have come from trampoline parks. And I mean, I don't mean to pick on them. You can put a welding shop in there. You can put a cannabis operation, a liquor store in there, and it's going to affect the rating too.
So, you know, I'm going to dig it a little bit into what you just said. Why would cannabis operation affect the rate?
Well, as Doug alluded to earlier, analytics are driving a lot of what insurers how they rate things today. And because cannabis is such a new industry, they just don't have the historical data on claims. So there's a bit of apprehension from insurers. They don't have the claims and loss history on that class of business yet. So they're tentative, and if they do want to write it, the rates are a little bit higher, we're finding.
And Rudy, just to touch on that, it's like liquor stores in the old days. Originally, we seen it where liquor stores were open, and when the LCB first closed them, because that's how old I am. And then all of a sudden you see shutters and concrete posts in front of liquor stores, and you've seen a drastic shift in the protection of a liquor store. And then we've seen more carriers get back into insuring. Well, with cannabis, to Matt's point, they don't have the data, but they have some predictive analytics around what first happened in a similar industry they fill. And they're really not sure what the losses are going to look like, building damage is going to look like, and the liability claims that could arise from a secondary building ownership standpoint. So they're just a little bit concerned of where that's going to go. We are seeing a fairly quick shifting in that because, especially because we're in Canada and the legalization, we're seeing a quicker shift where now we've got a couple of domestic carriers that have come back and said, yes, I'll insure retail cannabis shops. And that seems to be softening. But you still have the exposure of a national U.S. carrier that can't actually legally insure a cannabis shop because it's against the U.S. government. So therefore, because they're registered there, they actually have to get off risk. We've actually had buildings insured by U.S. carriers where they had to get off risk because cannabis operations were open up in the building and they can't carry that under liability. So
insurance is affected on the entire building then, Doug?
Yeah, in that case, we just had to change carriers. Now, it didn't change the rate of the building. We just had to find a new carrier, Rudy. But it just, again, to Matt's point, who's in the building and who you're leasing to. And this is all data driven because, again, the gray hair is not by accident. But if you go back 20 years, it was just what's the building, where is it, relatively what's it used for. And tenancy didn't really change it a lot. Today, it does. So again, to Matt's point, if you have a sandwich shop with no deep fryers, they're not too concerned. You throw 2 fast food restaurants in with deep fryers, now they start asking more questions about the maintenance, the scheduling, what are the contracts, who the contracts are, even for your tenant in maintaining that equipment.
And obviously the combustibility of the building as well.
Yeah.
Well, there you go. A little while back, 2 questions ago, I think I asked, is there anything that contractors can do to mitigate their insurance costs that really gets passed on to us, the developers? You mentioned, tidy work sites and obviously other factors, but is there one key driver that can actually impact insurance rates declining that we can ask our contractors to do?
Yeah, thanks, Rudy. I can touch on that one. So it's not one single factor, but I think to your overall question on getting favorable construction rates, there's a number of things that contractors can do or add to what they're already doing. So the process begins at the outset of the project. So the more information you can relay and give to your insurer and broker, the better they are able to assess that risk. Matt mentioned, they only have so much capital to invest. They're going to go for best in class. This is aimed at raising these contractors to the best in class risks. So, and one thing we've noticed in the hard market is that in the absence of information, underwriters are defaulting to the worst possible response you could give. So if you put NA on an application, they might be rating you for the worst possible response you could give. So probably some of the contractors on this call have noticed that insurers are nagging for more and more information, and this is why. Because brokers are realizing that in the absence of information, we're getting worse rates. So insurance application materials are more in depth than they've ever been. You're probably noticing applications be a little bit longer, and that's the reason for that. So applications and submission materials, and we go to market for a contractor, things we're looking for are site security, motion camera, CCTV details that Ken touched on, fencing and gating details. There's a couple of insurance warranties particular to fencing of an insurance project. Project site plans and geotech reports help underwriters assess soil risk, overall get a sense of the project site. Water shutoff measures we've touched on. That's newer to the game, but something we're adding into our application process. Fire protection measures, fire hydrant and fire hall proximity, things like that. And you know, we leave it open to the contractor. Like, what of your practices have changed? What are you doing now that you weren't doing 5 years ago that you found is an effective way of preventing losses? As far as general contractors, working with established and qualified sub-trades is also important. We are seeing insurers are now inquiring more and more to their GCs about the loss history and qualifications of their sub-trades, particularly when it comes to roofers. It's not rare nowadays to see a carrier ask for the loss history of the roofer on a large wood frame project. If that roofer is Joe's Roofing and he's only been in operations for 3 years and he's had 5 claims totaling $1 million, the insurer obviously uses that information when they're considering the risk. So working with established sub-trades and qualified sub-trades does actually filter into what we're seeing as far as insurer capacity. And then lastly, leaving your broker and insurers as much time as possible prior to the risk is crucial. I know sometimes, obviously, we move with the flow of the project. Sometimes that's not super possible, but the more lead time you can leave your broker and insurers to assess the risk and to analyze the information and follow up with you, the contractor, for more information, the more potential choices. If the insurer gets a submission at the 11th hour and you need insurance tomorrow, you're probably only going to get one choice, if that. If you start the process out 60, 90 days prior to launching of the project, all of a sudden you have 6 choices, 10 choices, you're not stuck with the one premium choice that you've got. So, our project insurers they go through the same flurry of work that contractors and developers do, especially in the springtime. So they're overloaded with submissions. So the more lead time we can give them, the better. And that just ultimately filters into lower construction costs on the insurance side.
Quite a few components, Danny. I'm a little bit surprised by some of those things you mentioned, especially the lead time, because oftentimes as a developer, we get a deal done, and as soon as we get the deal done, the contractor is already behind. And essentially, we put the onus on the contractor to make sure that they get insurance in place and things like that. And it's not due to the fact that we don't want to share information. It's unfortunately, it boils down to the fact of how deal structures work and how quickly we can get something signed on the dotted line. So thanks for pointing that out. We'll obviously, if you're working on a hard bid situation, it's going to be a lot tougher than if you work on, let's say, a construction management protocol. So it's something to definitely take into consideration.
And I think the one thing I want to add to that, Rudy, is we're starting to see a little bit more of a mentality in Canada where if you're in the US and you've got a score under X, under 1, you can't even get on a site in workers' compensation. If you flip that around to Canada, if you've got high loss ratios on your subs, you're going to be in the same boat. You're going to see insurance carriers risking their capital, to Danny's point, with the people that have done the pre-qual. And I think you're seeing a lot more GCs get a pre-qual standard if you don't qualify under these rates. And, each GC might have their own pre-qual standards, but their subs have to qualify. And if they don't bring them on the site. And that's what you're starting to see the carriers look for in Canada, is that pre-qual piece that follows all the way through, that you're already qualified or you don't get to bid. And I think what I would say to developers is taking a look at those same things. And developers had a pre-qualification of saying, okay, I'm only going to bring in certain contractors that qualify under these things from a risk management standpoint. You'd also find that your insurance costs would go down, but that might not drive the cost of development down, but it will start to drive your insurance costs down because the cost of the claims will be reduced. And we're seeing that across the board. We're already seeing some bigger developers in Canada moving that way, that if you're not pre-qualified, you don't even get to bid on the job.
Yeah. Okay, that's interesting. It's one of those, for developers, it's always a juggling act of costs on a project. Yep. And so some of those things that we would undertake to reduce the insurance costs may actually increase other costs in other areas. So it's obviously going to be one of that we'll always have to try to juggle and balance and mitigate our risk as well in trying to assume that. But it's good to know the education piece on that, though, because now we have other things to think about. Okay. This is a question that probably doesn't relate to industry folks, but I'm going to ask it anyways. It's a friend of mine decided to move to Vancouver, and he wants to know why his insurance rates are so high. Is it due to the fact he lives in a multi-story building? Is it due to the fact what you mentioned earlier about the residential focus right now in the insurance industry?
Yeah, I'll touch on that, and Matt, you can jump in too. But there's two factors in Vancouver. One is quake. So if you look at, I'm going to let Matt talk to the building itself, but quake capacity is an issue in downtown Vancouver. There's 2 London syndicates that just notified us this week they're out of quake capacity for the entire year. So if you put that in perspective, they cannot insure another dollar of quake capacity for the rest of 2021. And, so that has driven the rate. Some buildings in downtown Vancouver that originally were insured for about 6 cents, Rudy, as an overall building cost, including quake, now have a 7-cent quake loading alone over the building rate. So that has been a drastic change. And then the other reason is the capacity. There just isn't enough dollars of insurance as downtown Vancouver continues to build multi-story high-rise concrete. I believe the prediction right now is Vancouver will be $200 million short of capacity by the end of 2023.
Okay, well, I'll tell them not to live in a multi-family building than high-rise downtown.
Tell them to move to White Rock.
Yeah. Okay, great. Next question I have up here for you is actually it's something that interesting that's been popping up probably the last 6 months to a year for us in the development industry, and as we try to get some tenants, some retail tenants, we're finding that some businesses that are just starting out don't have a good track record. They're not able to get insurance actually. And obviously, we've gone so far down the road with this tenant already. We probably negotiated for anywhere from 6 months to a year, maybe even 18 months to 2 years, and then we get almost to the final step, and they can't get insurance, so we have to scuttle the deal. Can you maybe elaborate on why that's happening? Because this is relatively new for us. Maybe it's been happening before in the past, but we haven't seen it as much. Maybe you can share some insights on that.
Sure. Well, I think one of the drivers of this has been the hard market that this industry has been in for the last couple of years, with the capacity shrinking and insurers just not really wanting to risk their dollars on things they're not comfortable with. It's going to depend on the class of business that tenant is. Is it a trampoline park, a cannabis store? They've been extremely hard to insure. I think that there's a home for everything, and I think that Hub is a broker that can find a home for anything. With our expertise across North America, I don't think there's a risk out there that we could not insure. But for some of the smaller brokers out there that may only have 4 or 5 markets to go to, that's where they could run into these issues of, hey, we just can't find a solution for that client. Now, that being said, we can find the solution for the client, but that client may not like the pricing of that solution. So that could be something that deters them from purchasing the insurance or coming back saying, hey, we just can't find it. It may be because they just can't afford it. And that's just the reality of some of these classes of business and some of these risks out there today. And I think Doug had touched on some of the US carriers. When a cannabis store does come in, if that's a treaty restriction or exclusion for them, they have to get off risk. And every tenant in that building then that they may have to be looking elsewhere for insurance as well. So I think those are some of the main things, but it all comes down to price. I think if they're willing to pay the price for their business, we can find a solution and a home for them.
Okay, Matt. So basically, what I'm hearing from you on that is obviously it's a higher cost probably to the new tenants. Number one, whether they want to pay for it is number two. But also too, I've taken away that maybe I need to put the liquor store, the cannabis shop, the trampoline shop all in one building.
Yep.
I think that's a great idea. When you have the mixed high and low risk exposures, it does make that risk a lot harder to place.
Okay. Okay,
And I
that's
think,
interesting.
and all joking aside, Rudy, I think the one comment I want to make to the development side is make sure your certificates of insurance you're getting back from those insureds are actually what you need. We've actually seen it in a couple of industries where there's general liability has products completed operations. You basically get a premise only liability policy, and we've actually seen some certificates provided to our clients from some of these high risk businesses without the right coverages. And it's because to pay the premium to get the right coverage is expensive. And we keep talking about trampoline parks, but they started as a great family fun event. General liability policy was about 27 to maybe 30 grand a year, roughly. They average about 90 to 120,000 today. So if you were running that park and you went to start it up today, that's a pretty drastic change in your upfront costs.
That's quite interesting. And Nans, I'm just going to switch over to you for a moment. I understand we have probably a time of question for. I only have one more question to ask, but maybe Nans, you can step in there for a moment.
Yeah, I saw a question come in from the chat. Kathy, I was wondering if you wanted to unmute and ask a question, or if you want me to read it out for you.
Hi there. Can everyone hear me? Oh, good morning. Great job. So my question is, and it's, it's happening in the industry, and from a normalized perspective, there's lots of risk surrounding what I'm going to ask you, but I'm hoping that you or someone can speak to what's happening with the increased costs of labor, steel, and other materials, and the potential impacts in claim events, and what usual inflationary clauses are built into policies that could potentially protect everyone under the construction policies, but really what we should be concerned with to avoid under insurance.
Yeah, maybe I can start on that on the builder's risk and COC side, and then Matt and Doug could jump in on the completed building side as needed. So it's a great question, Kathy. It's something that we've been looking at very closely. We've looked at announcements coming out in the last few weeks and months. It's a topic of conversation that Doug and I have had in our last few construction meetings. So you're right on the money there. One of the things we look at is when you're insuring the building and setting up to insure the building for construction, one of the focuses that we have is you want to insure to at least 1.1 times the replacement value. A traditional course of construction policy, you're insuring to replacement value of the structure. So if that building burns down at day 189 of a 190-day construction cycle, you want to have a limit that at day 189 will replace that building for you. So the traditional focus has been on ensuring to 1.1 times the replacement cost value at the start of the project, just to leave a 10% buffer and a little bit of leeway for the general contractor throughout the life of the project. To your point, obviously, midterm or even start near the start of the project, if lumber jumps by 40, 50, 100%, your replacement cost valuation can be outdated and obsolete pretty quickly. So on the COC side, the focus is always going to be on just open communication with your broker and the insurance company. The focus is always going to be, is our replacement cost limit, if this burned down today throughout the life cycle of the project, as you guys look at your internal costs, is that limit adequate for replacement of the building? So, and that's on a standalone policy, a standalone COC policy where you have one dedicated limit. Some of the developers here and out there would use what's called a blanket course of construction policy, where you wouldn't have a limit specific to one project. And then making sure that that overall blanket limit is adequate for all the projects you have on the go. If lumber jumps by 40%, you might want to look at increasing your overall blanket limit with your insurance companies by 40 to 50 or 60%, just to allow a little bit of leeway there.
Thank you. Can you speak to potential coinsurance penalties and inflationary clauses as well, please?
Yeah, so coinsurance, for those that I won't drown everyone in insurance jargon with 9 minutes left, but coinsurance is basically an agreement between the client and the insurance company that they're going to be insuring the building or the property to X%. Coinsurance on a typical COC is usually 100%, meaning the insurance company expects you to be insuring to 100% of replacement costs at all times. On a completed building like what Matt deals with on the realty side, 90% coinsurance is more common, where the insurer says if you have $1 million building, you're responsible for insuring to 900,000. So coinsurance can become a big component when you're talking about an outdated replacement cost limit. So again, if your building is underinsured by 40% and you have 90% coinsurance clause, it can limit the payout on claims. So making sure that you're always up to date on the project limits throughout the life cycle of a COC is crucial. And then Matt, I'm sure would have some thoughts on appraisals and things like that once the building's ready.
Yeah, and we've been dealing with our appraisal companies on this for the last little while. We obviously know that some of these you get an annual appraisal done, and some of them that have been done 10, 11 months ago are now outdated and could be anywhere between 10 and 15% higher due to lumber costs. So I'm actually just going to read a little bit from an email we had from one of our appraisers yesterday. And they say that their costing database is regularly updated to reflect the current state of the construction market. They rely on cost guides, research with local builders and developers, and the construction price index from Statistics Canada. So they are aware that there is a problem right now with rising lumber costs and total insured values on these buildings right now. And we're working with them to make sure that our clients are up to date and their values are current, and they're gonna pay a total loss should there be one.
And Kathy, the other part of your question, there is some inflationary protection in some wordings. It's very restrictive and it's in very selective wordings where carriers will allot for an increase in building costs throughout the term of the policy. So if you insured your building in compliance with the coinsurance requirements or the stated amount on January 1, and that was the date of your policy expiry, and for the next 12 months, it goes up 15 or 20%, your policy would increase. In some cases, now this is where it gets technical. Some cases it would just remove the coinsurance penalty for partial losses, but would not pay more than what your policy stated. So I'm just picking a number, but if you had a $4 million building insured for $4 million on Jan 1 and June 30th, the building burned down, you would still only get $4 million. But if you had a partial loss, you wouldn't be penalized by the coinsurance. So the key factor behind that is, as a building owner, is make sure you're talking to your broker, taking a look at the wording. We use stated amount clause a lot, so that gets rid of the coinsurance requirements and it insures it to a building limit. And depending on the size of the developers, we'll use stop loss policies, because we'll say you've got $1 billion in property in Canada and it's separated enough that you're only going to lose $400 or $500 million maximum at any one time. So we may only insure $500 million of the property, but 100% of all losses on their properties up to that limit. So that again would remove that exposure. So I think it's just very important, as building lots and values change, as costing changes, to be sitting down with your insurers and your broker partners to find out what solution works best for you. Because, you know, we've built some creative solutions over the past 12 months for people in hospitality and different industries across Canada that have allowed them to not have to worry about right now about the value changes. They're able to take that in the policies that we're making for them.
Okay. Thanks, Doug. I think we have one more question, and then we have two more questions to get through here. So I'll go for Anand again.
Yeah, I'm going to read this one out because we've got two questions, and then and we'll do them each in about a minute, and then Rudy's got one final question. So I wanted to read out Jerry's question: how important has water loss mitigation become in discussions with insurers and developers?
I'm going to jump on this because I'm a little bit passionate, because I got my journeyman papers. I spent a lot of time building in my past, and I don't think enough. I truly think that this has to be something we have to discuss more. And I think it's got to come from both the building code, the city, and it's about making sure that the buildings are more sustainable. I do think early on, it appears to be a bigger issue, but as what I'm seeing from a project standpoint, it's being pushed more by engineers and systems than it is by cities. And I think developers, as they see the long-term benefit of sustainable buildings, will start looking at this, but the consumer also has to be prepared to take the cost, because it does cost more to build the building. So it's going to cost more to buy, lease, or operate the building. And I think that's where the trade-off has to come, is the public perception has to be okay with paying a little bit of a premium for a better, longer sustainable building. And I think what you're seeing is some work by some parties that are trying to prove that it's cheaper to operate the building down the road. So the upfront cost might be more, but then your operating costs will be reduced.
Okay. Thank you, Doug. Dan, was there one more question, or?
Actually, just reading Mike's question. It's a really good comment and a shameless plug, but not quite a question. So I'll direct you to take a look at that in the chat, talking about their civil engineering firm and their work on fire hydrants. So
okay,
take a look at that one.
Yeah, the answer to your question or comment, Mike, is yes. I think again, this goes back to Danny's comment about information. It's similar to some work I've done in small towns, and I know, Ken, you guys do work in some smaller places. And, if you can find out what the water pressure system is the last time a small town had their main water line replaced, or what the water flow pressure is in a small town, it can actually decrease the FUS rating, which is the fire inspection code rating, and give it a better number. So I lived in a small town. We had almost unprotected fire code rating. They replaced the main water line, but nobody updated that to the insurance carriers into the fire inspection code. By doing that, we went from a 7 to a 5, and basically increased capacity in that small town and reduced overall insurance rates in that town by about 10%.
Yeah, Doug, it's a really great point. I mean, on almost every project, we need to go through that process anyway. So it's just a matter of just getting it up in the queue a little quicker. That's all.
100%. And again, it's just to Danny's point earlier, and I know Ken brought it up. It was more information is better.
Okay. I'm sorry. I've got probably 2 minutes left here before 11 o'clock, and before 10 o'clock. I'm going to ask one more question. What should we expect from the insurance industry over the next 12 to 24 months?
Danny, I'll take it. So I really think we're going to see a stabilization. I've got some of my competitors and some of my colleagues think I may have got too old now, but I think with the data we have, with the capacity we have coming into Canada, we've got more capacity coming in. As a North American broker, we have many US carriers. We've got international carriers putting money in Canada. There's a lot of new options to the table. You're seeing reinsurers bring capacity into Canada. So I think you're going to see a stabilization by class. But I think what you're going to see is an industry that's really going to strive for loss prevention and mitigation. I think you're going to see an industry that, as they put their capital to risk, and we've said this repeatedly, but the best in class are going to get the best terms and conditions, regardless of the class of business, because the carriers are basically risking their dollars. And they're going to say, I would rather risk my money with client A than client C, and here's why. And that's what you're going to see, but it's going to be a much more stable market. I don't think you're going to see the highs and lows that we've seen in the past 3 years. I think you're going to see a lot more stability. And I mean, again, that's in general, there's going to be some clients that are going to be hit, but I think those will be the ones that we would all agree are not the best in class operations, and therefore they're going to get higher rates and premiums. And I think most people are okay with that. They want to see the best in class risk at best in class rates. And I think that's where the industry is headed with the data and analytics they have today.
All right, great.
I would just add to that really quickly, Rudy, by function, we've had to see a lot more creative solutions for insurance needs for clients over the past 3 to 5 years. I think you're going to continue to see that in the coming years. The one positive that we've seen is, this has brought a number of new insurers to Canada and in new classes within Canada from overseas, like Lloyd's of London, like Doug mentioned. So I think that creative approach to finding insurance solutions where 10 years ago, it was just, go out and find one carrier who can write everything. I think we're going to continue to see more and more of a creative solution used by brokers and clients with some of these new carriers that, we've seen that they can post profitable quarters and years when operating in Canada under new product lines. So we'll keep an eye on that and obviously continue presenting that to developers and contractors in the next couple of years.
Okay, great. Thank you. I would like to thank everyone, first of all, for attending today and getting this information. And very special thanks to Ken, Dan, Doug, and Matt for providing your insights and helping us all understand this. So thank you very much. I just want to close with actually saying that hopefully we'll see you at the next NAIOP event, next breakfast event, or even lunch event. And thank you once again so much for taking your time today. Have a great day.
Thank you.
Thanks
Rudy.
for having us.
Thanks, guys.
Take care.